Welcome back, you legends. I'm Dr. Cal, and let's get right into this video. The stock market closed down on all three major indices. The S&P 500 was down 1.15%, the NASDAQ 2.26%, and the Dow 0.52%. On the stock market map, we can also see that the stock market has been split down the middle. Again, we have Google, Facebook, Amazon, Tesla, and the semiconductor stocks taking the biggest hits, with Tesla going down by as much as 6.5%. That's huge, guys. We have a bit of green in utilities, real estate, healthcare, some basic materials, as well as some consumer staple stocks. And that's very typical of a risk-off move. Look here, guys, we have cyclicals, communication services, and technology leading the losers, with very significant losses here, guys. Utilities, the only sector closing in the green and barely in the green, more like flat to be honest. Then we have consumer defensive, healthcare, financials, and industrials closing just below 1%, energy closing 1% down, real estate 1.16% down, and basic materials 1.35% down. So it's definitely not looking pretty for the stock market, guys. And now let's take a look at the futures market. The futures are open as of right now. It's 4 a.m. Eastern time, and we have all four major indices in the red: the Japanese index, the Euro index, and the German index, all in the red as well. And we have the VIX spiking up, as well as energy prices going down and bonds going up. Now, this is a bit of a strange development, guys, because what we tended to see when the 10-year yield goes down, tech goes up, and that did not happen yesterday, even though we had this absolutely massive bearish engulfing candle on the 10-year yield and a continuation to the downside today. We're not seeing tech go up, we're not seeing growth stocks go up, we're not seeing the NASDAQ go up. So there's a bit of weirdness going on in the stock market today, guys. Perhaps it's just the futures market playing tricks. We will see what happens when the cash market opens. We need to see the NASDAQ go up and the 10-year yield continue to go down. If not, then something has to give. Now let's jump into the NASDAQ. This is the QQQs, the daily chart for the NASDAQ ETF. And yesterday we had this bearish candle right here closing at the bottom of the previous 2 days. We had a bit of a gap right here. We filled that gap, guys, yesterday. We are still positive on the MACD, but we do have some bearish developments in the smaller time frames, guys. We now have this bearish crossover in the MACD on the 2-hour chart. This doesn't necessarily mean that the market will sell off immediately. We could see some consolidation here, some choppiness, just like what we had right here. But I do not expect a lot of upside left in this rally, guys. And there are a couple of reasons that I will jump into after we take a look at the S&P 500 right here. Now, the S&P 500 held up a little bit better than the NASDAQ, despite the fact that we saw the 10-year yield drop yesterday, which should have helped the NASDAQ outperform the S&P 500. This did not happen, unfortunately, primarily because of that massive sell-off in Tesla, bringing down the entire NASDAQ index. Now, the S&P 500 is looking a little bit better than the NASDAQ, but not that much better because, again, we have this bearish crossover on the 2-hour chart. Now, the last time this happened, we saw a sell-off right here. But again, it's possible that we see some consolidation like what we had right here in the early part of June. Some choppiness perhaps as we get some of the economic data that's scheduled for this week, including the CPI on Wednesday, and then the consumer inflation expectations and consumer sentiment index later in the week. Now, the reason that I said, guys, that this rally probably doesn't have a lot of legs left is because of this. Look at that. We had a break of the support line by the VIX, the volatility index. And remember, guys, when volatility goes down, the stock market goes up. So this break was actually very, very important. But what we have today is a little bit tricky because we're seeing volatility jump back up above the support line, and that's not a good sign. The last time we had something like this happen was right here, guys, on the 9th of February. And let's jump into the 9th of February to see what happened on the S&P 500. And it's right over here, right there. 9th of February, and look at that. We had an absolutely humongous sell-off in the stock market that took us down by about 10 percentage points. Look at that. That was a pretty nasty drop. A 10% drop from the top right here would take us all the way down to $350. And what is exactly sitting at the $350 level? Look at that. The 200 period weekly moving average. And it's sitting right at this gap level right here that I should mark with a box, like so. It is very likely that we will see a fill of this gap right here. if the market decides to sell off. And it is looking a little bit treacherous, guys. The market is not looking that great. Now, there's another reason that I'm saying that the market is probably heading for a sell-off pretty soon. And it's this, guys. This is the Fear and Greed Index by CNN. And I'd like to take a look at the put to call ratio, guys. The put to call ratio tends to be a contrarian indicator when people buy a lot of puts, like what we saw right here at the top. In the middle of June, we tend to see the market actually bottom. And when people become complacent and buy calls more than they do puts, which is where we are right now, right here, the market tends to sell off, okay? And the put to call ratio, guys, has actually been in a positive uptrend going all the way back into early November when we saw a lot of stocks begin to crash. So we've been making higher lows. Look at that, a low, a higher low, another higher low, and then another higher low right here. We haven't even managed to break this low in early June. And this does not look good for the stock market. And there's a third reason that I think we will probably see a sell-off in the stock market, or a continuation of the sell-off in the stock market. And it's this, guys, seasonality. We had seasonality play in our favor going into the late part of June and into the middle of July. We usually have this small rally right here. We already had that rally. And then in the middle of July, just around the 13th, 14th of July, we tend to see the sell-off and then a second leg of the rally come in after earnings come out. But again, guys, I've explained many times why I do not believe that the second leg of the rally is going to materialize. This second leg of the rally depends entirely on earnings, and earnings will probably most likely disappoint because earnings expectations are very, very high, unrealistically high. And so the stock market will be disappointed by the slightest miss in these earnings, and that will take us down considerably and precipitously, going all the way into the late part of September and the late part of October, right before the election results come out. Now let's jump back into these charts. We have Nvidia right here, and we haven't been able to clear this resistance line of this descending wedge. Now make no mistake, guys, a descending wedge is a very, very powerful usually bullish technical structure, but we have to break resistance for this to materialize. We haven't been able to break resistance right here, so I'll be looking really closely at what happens today on Nvidia. If we continue to sell off, then that's a wrap on Nvidia and the semiconductor index. And remember, the semiconductor index is a really good proxy for risk appetite in the stock market because it operates somewhat as a leveraged index of the NASDAQ. It's not really a leveraged index, but it's an index with a higher beta than the NASDAQ. So when the NASDAQ moves up, the SMH, the semiconductor index, moves higher than the NASDAQ, and when the stock market begins to sell off, the semiconductors sell off more than the NASDAQ does. Now let's take a look at AMD. Same thing with AMD here, guys. Even though we have this white space right here where we could see a lot of upside, AMD is beginning to slightly outperform Nvidia. We almost had this bullish crossover on AMD, but it did not end up happening, and we sold off. We could see a continuation of this sell-off, or perhaps we could see a crossover going into the next couple of days. We will see what happens. AMD tends to report earnings in the last week of July. Okay, so we will see what happens with AMD here, guys. We saw AMD do really, really well after the last earnings that they reported, because they beat on the bottom and the top line. And I do expect AMD to beat again on earnings, primarily because of taking market share from Intel. Okay, not because the economy is going smoothly or anything like that. The economy is declining. We've talked about that a lot. We're seeing a lot of signs that the economy is slowing down, but this is a different story for AMD. It's about taking market share. It's not so much about the economy. So this is an interesting play. We will see what happens with AMD on earnings. Now let's take a look at AMC. AMC continues to perpetuate to the upside, but it's slowing down. We're seeing a consolidation here at the top of this candle right here. We are still in positive momentum on the MACD. I'm still looking at this level right here for a short. If we see AMC touch this 200 daily moving average, I will be shorting AMC for sure. But then again, if the market decides to sell off today or tomorrow after the economic data comes out, or ahead of the CPI report, which is coming out tomorrow, we could see that happen, guys. The last time the CPI report came out, we saw the market sell off a day prior because the CPI report actually leaked out. So if we see a bit of shenanigans today in the stock market, if we begin to see significant sell-off today, guys, if we see significant changes in the smaller time frames, the 1 hour and 2 hour charts, that would be a huge red flag, okay, to exit the market. Now let's take a look at GME. This is the daily chart for GameStop. GameStop still not looking that great. We have what looks like a bull flag right here, but in a bearish context. Why? Because we've been selling off. We're now below the 200 period moving average, and we have this head and shoulders pattern where we have the head right here and a couple of shoulders. Again, this is backed up by the MACD, a head right here and a shoulder right here and another shoulder right over here. I do not like GameStop at these levels. I think that GameStop will continue to bleed out for the foreseeable future, guys. Now let's take a look at the big daddy stock, Tesla. Look at this absolutely humongous sell-off in Tesla. And Tesla has been actually been uninvestable, guys, going back into late May. All of this consolidation has been uninvestable, untradeable in Tesla, to be completely honest with you, and it has to do with Elon Musk screwing around with that Twitter deal. Now the news is that Elon Musk has actually pulled out of the deal. We will see what happens. There will be legal repercussions by the Maryland court, so we will see what happens. But to be completely honest with you, Tesla is uninvestable at this point, and the reason is twofold. One, a lot of negative press around the Twitter shenanigans that have been going on with Tesla and Twitter. And the number two reason, guys, is Tesla is insanely overvalued. And the third reason, there's a third reason actually, and it's that I expect Tesla to sell off and fall like a rock after it reports the upcoming earnings. And that is because of the China lockdowns that we had recently. They really hurt Tesla in both production and sales of vehicles. So I do expect Tesla to miss the earnings. And again, look at how insane this run-up has been since that March 2020 low. Look at that. That is absolutely nuts. And let's put a percentage on it. Tesla went up by over 1,600 percentage points. That is absolutely insane. I do not believe that Tesla can support this absolutely insane valuation. Okay, it just cannot support this insane valuation as the Fed continues to tighten. Tesla will probably do something like this, where we have a topping formation with an inverse cup look like so, and then a precipitous sell-off towards the end of that run. And we will see where Tesla ends up stopping or consolidating, and it's probably going to be around this level right here, guys, at the $160 to the $200 level. Okay, but that's going into the late part of 2023. We're not talking about this year. It could happen this year. Anything could happen with the stock market. We will see what happens. But on the medium term, guys, I do not think that Tesla is investable, to be completely honest with you. The valuations again are just insane. Now let's take a look at the upcoming economic events that we have this week. Today, Tuesday, nothing really important. We have the Richmond Fed President, Tom Barkin, speaking. I don't expect that will move markets too much. Then we have the Consumer Price Index coming in tomorrow at 8:30 a.m. Eastern Time. And we also have the PPI, the Producer Price Index. In my opinion, the Producer Price Index is a lot more important than the Consumer Price Index. Why? Because this figure reflects what companies are paying for raw materials rather than what the consumer is paying at the store. And what tends to happen when inflation skyrockets like what is happening right now, we see the Producer Price Index run up like crazy. The last reading was over 10%, and then we see the Consumer Price Index come in slightly below the Producer Price Index, and that's because producers tend to want to absorb some of that cost and not pass it on to the consumer, and that is because they don't want to lose market share, they don't want to lose sales. Okay, so this is more important than the Consumer Price Index. We will see what happens with the PPI. And then on Friday, we will have retail sales as well as the consumer sentiment index and the 5-year inflation expectations. So a lot of economic figures coming out on Friday. And the market, to be honest, could sell off on any one of these. It could sell off on the CPI tomorrow or today ahead of the CPI print. It could sell off on the PPI. It could sell off on weak retail sales. It could sell off on really terrible consumer sentiment index, and it could sell off on 5-year inflation expectations going up more than expected. But we do have a hint that this will not happen with the the 5-year inflation expectations, because the 3-year inflation expectations actually came in at 3.1%, I believe. It's not reported here. This tends to lag a bit. Market Watch tends to lag a bit, but it came out yesterday. The figure was below the previous reading. So that's good news for the medium term. It just means that people do not expect this, that this inflation will last forever. Anyway, guys, that's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow!